Today's number is 7 because we've only seen a market flash crash like this at all-time highs that many times since 1985. And we need to talk about it both from an investment and trading angle. As flash sells come in across the stocks and, of course, crypto markets liquidating over 1.5 million accounts, what exactly is going on? Could it be all about these tariffs, or is it actually a bigger part of the puzzle that Wall Street is playing on us just as retail go all in? Well, today we'll take a look at the data surrounding everything, including the fact that even the bonds have started to freak out a little. Let's take a look at whether Friday was the lows and what we can expect in the next coming days, months, and weeks across the stocks, commodities, and crypto markets. Don't go anywhere, everybody. This is wild, and we've got a lot to talk about. Well, welcome back, everybody, to the special weekend edition of The Daily Show. My name's Thomas Atkinson, and as usual, we'll be going through the macro, the data, and the key levels that you need to be watching right now as on markets, including the option zones and the fact that we're back in negative gamma. So with one of the biggest sells of all time at all-time highs happening, we need to really pay attention to what's going on. And with people also calling a bubble right now, could this be the beginning of the end? Well, we've got some awesome charts coming up, but let's start off with where it all started, which of course was based on this Trump tweet of tariffs of 100% being put on China as early as November the 1st in retaliation to, of course, the curbs on things like rare earths, minerals, and metals. Now, as this was happening, we see a couple of other problematic signs. One of them was, of course, over 1.5 million accounts were wiped out in the cryptoverse. Yes, people lost big time. And of course, as FOMO and euphoria started to come up, what tends to happen? Well, we tend to see this type of volatility come through. Whether it's that tweet, whether it's something else, this is a story as old as time. And as we mentioned in our last two videos, it was starting to become clear that retail was all in, literally going in big time, and you'll see in a moment why. But you can notice on this particular post here that accounts were opened out of nowhere during the event. And of course, we know nothing more than you guys do, and we have no idea what's going on in particular on this aspect. But Vivek actually came out here on X and posted, and I reposted this over on our X account, following the links down in the description down below if you want to check that out, that $88 million was made in the matter of a few hours when it came to shorting Bitcoin out of nowhere. On top of this, we also saw a whole bunch of, as I said, leverage accounts getting wiped out, and it could be an opportunity for us as traders and investors to potentially buy the dip. But could it keep dipping first? Remember, these markets did close all the way on their lows. Well, one thing that could be a bit problematic is also what's going on with the US dollar. And you guys know that 10-year rolling change percentages can have an impact. And this one here is from Tavi Costa. And it shows epic cycles throughout time of the US dollar going from incredibly strong to relatively weak. And you can see here that it looks like we could be in what we call a weakening cycle, which has started off at the start of the year. Remember, one of our big trades this year was, of course, weakness in the dollar. And we mentioned that back in January, and it's so far been, pretty effective. What have we been doing instead of selling the dollar, though? It's been buying gold, silver, and other precious metals. And actually, they were one of the only things that held in the market during all of this chaos that happened on Friday. So why is this important? Well, it's something to keep in the back of your mind when you're taking a look at history and what could be in store for the dollar moving forward. And remember what happens right now, which we've been noticing a little bit of bullish action, which of course looks like it was defensive now, is only a microcosm or a blip on the horizon of what could really be happening over the next year or two. Now, as always, Tom Lee's come out over the weekend and he's had a few things to say. And again, I tend to agree with him when you look at the data later on. But as you can probably guess, he's relatively bullish on this particular high volatility drop. Now, there are some reasons behind that we'll share soon. But one of the things that I thought was most interesting, and we do know this is a statistic, is Fridays don't tend to be the lows on markets. And I think this is important when we have a look at the charts and we check out what actually did happen when it came to the Friday close. And we've got more on that coming up later on today's show. But let's look at why this could have been an excuse to be used against us as retail traders, particularly as everybody turned bullish. Now, as we saw in the last video, we talked about the fact that the sentiment surveys switched. Now, it wasn't so much that more people turned bullish, although they did. It was less people we're committed to the bear side. And as you guys know, when nobody's neutral, which of course has been for a little while right now, it means that we have a polarized side. People that say we're in an AI bubble and it's going to explode, and people that are, of course, like, who cares? I'm going to make money. Let's get in, leverage, baby. It's all good. And at the same time, we've also seen a huge rise in, of course, 3 times levered ETFs, which I do find to be a very big cause for concern in the future. Not so much right now, but when you're taking a look at 2026, I think this could be a huge problem as retail traders take more and more leverage and get more and more liquidated near the top. Remember, this is the thing about markets. When everybody gets access to leverage, that's when the biggest gains, but also the biggest risks start to appear. So let's take a look at the rolling 1 month estimate retail demand. We already reported this 2 days ago on our videos. So that was, probably about 3 days or 4 days ago now. And it was from Morgan Stanley. And it actually showed here that we had the largest ever retail demand inflow ever recorded in the history of recording. Now, the last time we saw a number like this, yep, you guessed it, was actually February of 2025, leading to, of course, an epic sell. So as you get this bullish in the future, well, it's going to be a cause for concern. Another thing that we've been seeing is you might say, well, this is a broad market, everything's going up, it's all fantastic. But actually, this has been a stock pickers market. It hasn't been that interesting on the indices. It's been actually more interesting on making sure that you're in the right stocks. And weirdly enough, this actually happened before 2018 when we got Volmageddon. And also, yeah, you guessed it, a trade war with China. So why was this so big? Well, I think it really shows that certain asset classes have been doing well. Metals, semiconductors, things to do with AI, they've been some of the best, while other areas of the market haven't been that hot this year. And it really does show that sometimes you need to look at the sectors and underneath the hood, which is something we do, of course, together here on the channel. Another warning sign was, of course, that we hadn't seen a 2% pullback on the NASDAQ in 1 day for a very long time. Now, we ended up getting to about 117, 118 days since we last saw it. And you guys can see here, well, guess what? It was a little while ago since we saw these, but around that 115 to 117 was the normal type of point where we'd usually see a sell-off. So it's kind of like a random coincidence maybe, or maybe not, that all of this is happening at the same time and that markets have been holding in defensive sectors. Now, we often say if you get a few days of defensive pickup, that's something to be looking at. But take a look here at the 5-day rate change in terms of what's been holding up. Metals, pretty good, 3.4% up. Nice, we love metals. Utilities, nice. Staples, out of nowhere, not dead over the next 5 days. And healthcare, another sector that we thought had a thrust in it recently, barely down. On the flip side of that, you've got other market sectors, admittedly one of the ones that we've been looking at, which is obviously oil, that have not done so well. And home builders in particular and consumer discretionary have been suffering. So it'll be interesting to know how this event occurs and continues to progress, especially over structure of the next 1 to 3 months. Now, let's talk about this structure a little bit more, because as you guys know, I'm big, and I'm sure a lot of you are as well, on watching what they're doing, not what they're saying. In fact, Paul Tudor Jones came out the other day, and I think one of the other guys on X, was it Finance a Lot, I think it was, he posted it, he mentioned it to me as well, that we have had, Paul Tudor Jones came out, and he's like a little bit wary about that, because he was like, it's a great time to buy the market, guys. Remember, don't do what they do. Don't do what they say. Do what they do. You always need to be careful out there. And one of the ways we track that is by seeing these types of events. But more importantly, we also